I went from zero assets to financial freedom in 5 years, and I can show you how to do it even faster. There are 3 secrets to achieving financial freedom faster. If you want financial freedom, these are the 3 secrets. First, make a mental commitment. If you are not committed, it will never happen. Second, learn to create money, create wealth, so you have more money to grow. We show you 4 ways to create wealth in another video. Third, build the perfect investment portfolio, a bulletproof portfolio. And I'm going to show you what should be in your portfolio. And I will show you the right order to build it so it grows the fastest. This is how I went from $0 to financial freedom in 5 years. So what makes it such a good portfolio? There's 3 keys: better returns, true diversification, and cash flow. Let's talk about each one of those. So first of all, you need better performance and you need better returns. Many of the investments that I utilize earn 50% a year or more. Several of them, more than 10% of them, are earning 8 to 10% a month or more. In other words, they're doubling every year. So that is a huge advantage. Some of our best performers, again, are making 100% a year. A lot of our mid-range returns are in the 30 to 50% a year range, and our low performers are making 10 to 12% a year. These are unique strategies that licensed financial advisors cannot offer. I was a financial advisor for 10 years, and I know how that works. That was the industry that I was in, but because of the way the regulations work, they cannot offer many of these investments that we'll show you. And lastly, a lot of these investments, they actually are private or by invitation only, and so you cannot find them just by searching online. And again, that's why it's important to have someone who can introduce you to those. So getting a good return, a better return than what you would get elsewhere, is one of the keys to a bulletproof portfolio. The second key is true diversification. There's a term called non-correlated. It's just a fancy word that means not correlated. And one of the best examples of how this works is 2022. Think about what happened in that year. Inflation skyrocketed. The stock market dropped 20 to 30%, depending on what index you're looking at. Crypto dropped 70%. But what happened to your prices of your food at the grocery store? It went up, and by quite a bit. One of the areas we diversify a lot into is agriculture. And so the cash flow, the passive cash flow that I get from all of my different agriculture investments, they all went up a lot. Most of them by well more than the 10% inflation. And so that's diversification. When 1 or 2 things go down, it doesn't impact the other 3 or 4 or 5 items or markets in which we invest. That gives you true diversification and protection. Plus, it does provide inflation protection. Agriculture in particular, when inflation goes up, food prices go up, cash flow goes up. So that's one part of the diversification, and we'll diversify across 6 different markets. In addition, we will go and diversify within each of those 6 markets. That's true diversification. The third key is to focus on passive cash flow. Financial freedom requires cash flow, not a pile of money. I've seen many reports that talk about how much you need to have so that you can withdraw 4% a year and not run out of money. And I can tell you 20 years ago, that number was 6 or 8%. People thought the market was going up enough that they could pull out 8% of their balance every year. But what happened was they were pulling out 8% per year, and then the market had back-to-back really bad years, and all of a sudden people lost half their money, and it ended up just ruining their entire retirement. They did not have enough money. So a lot of companies say you can't pull out 8% or even 6%. You can only pull out 3 or 4%. But if you've got passive cash flow, you never have to worry about that. Your assets are sending you money every month. As long as you have enough money coming in that you cover your budget, your expenses, you will never run out of money. That is financial freedom. So again, the focus is on passive cash flow. Now, while you're still growing and you don't need that money to pay your bills, you can reinvest all that unused passive cash flow to compound your growth even faster. And lastly, I talk about passive cash flow and kind of think of that as streams. And this is, as you create these streams, You've got all this money flowing by and you use it as you need it. But at the same time, it's good to have some emergency funds, and we call those wells. You kind of set that money aside, and that could be in gold, a savings account, cash value life insurance, just a normal stock portfolio, whatever. But you kind of separate what you have into what I call streams and wells. And if you focus on the streams and building that passive cash flow, it will greatly improve your overall financial situation. So those are the three keys: better performance, diversification, and passive cash flow. So let's dive a little further in and start seeing what that's going to look like. When you have enough passive cash flow to cover all your expenses and that cash flow is well diversified, then you have financial freedom. That's the end goal. As Stephen Covey says, with the first of the 7 habits of highly effective people, begin with the end in mind, then work backwards to achieve that end. So I'm going to show you the portfolio you want to end up with. The best way to get there quickly, we'll talk about later. But we use a 6x6 grid going across. This shows the diversification across 6 different markets. Like I said earlier, these are non-correlated markets, so your portfolio is protected. So you go wide across 6 different markets. So here's just an example of a few of them. Talk about stocks, we invest in real estate, agriculture, and we have 3 other markets that we utilize quite a bit of, and I can't share with you in this video right now. But we go 6 wide, so you've got diversification. Then you go deep. When you go deep, you diversify within each market. So what does that look like when you put it together? Well, you've got 6 different assets across, and within each, 6 different markets across, and within each market, you've got at least 6 different assets. So you're diversified within each of those 6 markets. Again, you don't want to invest in the stock market and go buy one stock. That's not diversification. You want to diversify, and frankly, even not just one fund. You'd want more diversification within the stock market than that. And the same concept goes across agriculture. I just kind of shared a few things just as an example. But this is going deep within your portfolio. So go wide across 6 different markets, go deep within each of those markets. So how do you get there faster? Your overall portfolio has a great diversification. And again, each investment has its own market value, and each asset has its specific cash flow that it generates every year. When you add all that up, all that passive cash flow, if it's enough to cover your monthly expenses, you have financial freedom. Now, does that mean that all 6 markets are equal? No. If you buy the right assets in the right order, it builds your portfolio much faster. And we have a couple markets in particular that we use because they create such high cash flow quickly. By using these assets first, you generate high cash flow that you can then use in order to invest in other markets. So here's an example of a couple of those markets that have really high immediate cash flow. And when I say really high, again, we're talking at least 5% a month. A lot of these are between 10 and 15% monthly returns, and you use that cash flow to invest in the other markets for longer term. So let me explain long-term and short-term. If you think about this, real estate is a long-term passive cash flow investment. So in other words, if you buy a house and as long as you maintain it, it could provide cash flow for you as long as you're alive. Houses last decades. And so that is a long-term asset that will create long-term cash flow. Others are actually more short-term. They may generate a higher cash flow, but it may only last 5 or 7 or maybe 10 years. And so you couldn't retire tomorrow based on cash flow that might end in 5 or 7 or 10 years. You don't know exactly when it's going to end. And so long-term, you want to have enough passive cash flow from long-term investments, not from the short-term ones. And so how do you get there? Well, some people ask the question, well, why don't you just start with the long-term cash flow? The problem with that is this: they get lower returns, so you have to put more money into them. In other words, let's say you wanted to generate $12,000 a year of passive cash flow. If you're going to buy a stock portfolio that's paying dividends of 6%, then you'd have to put $200,000 into that dividend portfolio to generate $12,000 a year. One of the markets we utilize, the returns are a little bit higher. You'd only need about $100,000 to generate $12,000 a year. A couple of the other markets, you might only need $40,000, in our best performing market, you could actually generate $12,000 a year of passive cash flow with only $10,000. And so the best way of understanding this is I use a campfire analogy. When you go to build a nice little campfire, those logs, those giant logs, are going to burn for hours. And that's great, but you can't just put one giant log on there and light it on fire. You've got to use kindling and maybe some newspaper or paper or whatever to get it hot enough to get things going. And then once that catches fire, then you're going to be set for a long term. And that's kind of the way to look at these. These short-term assets generate high returns that then you utilize to invest in and buy the midterm and longer term assets that will keep your cash flow going for decades. And so that's just kind of a different way of understanding how we use the high return short-term cash flow to fund and build your long-term passive cash flow. Lastly, let's say you had $100,000 to put into agriculture. That would create a return of 20 to 40% average over the next 25 years, but that average includes zero in the first 3 to 4 years because you have to wait for the trees to grow. If you put $100,000 into something that's paying, let's just say 40% a year immediately, then all of a sudden you've got an extra $40,000 a year to invest in years 1, 2, and 3. Again, if you're making 60, 80, or 100%, obviously you've got even more cash flow now to invest for the long term. So using the right strategy keeps your money moving. This is called velocity. The better you use it, the faster your money grows. So once you've gone 3 deep and you've got these assets generating high cash flow, as you can see in market 4 and market 5, now you've got money and you can start going wide. You use that cash flow that you've created to invest in stocks, real estate, agriculture, and other markets. And so now you start using that to go wide. And before I finish the video, please take a second to like the video. If you haven't already, please subscribe so you get more fresh content on how to build passive cash flow. Finally, if you have any family or friends who would like to improve their financial position, please share this video with them. Thanks, and I appreciate that. So you've gone wide and you have more diversity. You've thrown in a couple of big logs onto your campfire. Now go back and add a little more kindling. In this example, you can see I went from going 3 deep in markets number 4 and 5 to going 6 deep. So now you've got more things generating that high cash flow. So what does that enable you to do? To add a second item across each of the other different markets so that you're going deep in all of your markets. Use that higher cash flow to go deeper in the other markets. Next thing you know, you'll go deeper and deeper, and you will have a diverse cash flowing portfolio across 6 different non-correlated markets. And within each market, you have diversification. You've now got passive cash flow coming in from 36 different investments so that you can retire and have financial freedom. Please go to unbrokeninvesting.com to join our paid community. This will give you access to those amazing investments that generate the high immediate returns, as well as the investments that create long-term stable passive cash flow. It also gives you access to our many live weekly calls on different investing topics, as well as access to members of the community who are already doing what you want. They are building their passive cash flow. Have a great day and live richly.